You know, who's this? The classic, it's beginning to feel a lot like Christmas. Well, not really appropriate for today, right? But supposedly the Christmas rally starts today. Not only that, you're looking right now at the screen of every single day the market is open since 1950. And guess what day is usually the best day in the market? October 28th. Also, the guy who put that together, Ryan Dietrich, it is his birthday too. Happy birthday, Ryan. All right, let's bring in Market Gauge Managing Director Michelle Snyder, along with Solus Alternative Asset Management Managing Director Dan Greenhouse. Don, you got to get a few less things in your title. How about the man? How about the man Dan or something like that?
We can, next time I'm on, if you want to introduce me just that way, fine.
I'm just glad you didn't have us put in all your different degrees. You know, we'd still be here.
I didn't write the copy.
All right. I'll start with you, Michelle. It's tough, right? I mean, it's just, and it feels tough and contradictory. I mean, we're talking about inflation, recession. We're talking about rates too high. I mean, it's just, how are you dealing with this? What are you telling us investors?
Well, you're absolutely right, Charles. I mean, as far as the conflicting signals, I've never seen anything like this before. But I started out this year thinking square peg, round hole, and that's proving to be right. And also looking for inflation in all the wrong places, and that also is starting to really look like the scene. So essentially, we have had a major breakdown. I mean, there's no denying here that 4,200 level that everybody was looking at. We haven't been able to get a bounce, even though market breadth suggested so. So at this point, and throughout most of the year, my focus has really been in the commodities area, which has been the place to be, and looks like that could continue to be a trend as we
remember your sugar call. Phenomenal, absolutely phenomenal. Dan, what do you make of it? I mean, so, you know, we get this data out, and then there's always the knee-jerk reaction. Everyone's got an opinion. But it feels like the same consequence happens, you know, particularly lately. At 3 o'clock, the market starts to sell off, and everyone heads for the hills.
Yeah, it's a really difficult trading environment right now. If you look at some of the big tech reports that recently came out, they weren't particularly bad.
Right.
I don't cover these, I don't follow them, and Solus isn't a particularly large tech investor, but if you look at like Facebook and Microsoft, those are really good reports, and obviously Google had some issues on the cloud side of things, but it's still doing on balance okay, and obviously their reaction to them has been meaningfully negative, which tells you if a good quality report can engender a positive response from investors, that there's a larger issue at work.
Now, someone may argue and say, well, the greatest report was probably baked into the cake since these stocks had made such huge moves, but the other side of this was all year long was that once those stocks started to falter, money would rotate because the rest of the 493 stocks were deliciously undervalued, but that's not happening.
No, it's not. And actually, if you look back to, like, call it the middle of July, when rates started going up and equity started to react negatively, the S&P 493, if you will, is doing just as bad as the S&P 7. There's been really nowhere to hide. That's not entirely true. Netflix had a very good report and is up, but on balance, the entire market is suffering right now.
It really is, and so. In a situation like this, I know that you're always looking ahead, so you're probably looking for the names that are probably most oversold or sectors that are most oversold to that point. Is anything beginning to stand out that, okay, I want to be there when the dust settles?
I definitely have a list. I may not necessarily be so interested in the really weak stuff because it is obvious at this point that this is a different market and the really weak stuff is weak for a good reason. So what I'm rather be looking at right now are stocks like an Intel that had also a solid report, or a Tesla. You know, I'm not jumping into anything here, but things that will eventually get to a support level that outperforms everything else, but gives us a very good point of risk so that if we're wrong, exit quickly.
So what are you expecting from the Fed next week then, Dan?
Yeah, I don't expect them to do very much of anything. I think that's consensus. The market's pricing in somewhere around a 97% probability of nothing happening, and that's probably too low. It's probably 99 or 100%. But the commentary...
It's got to be a wink and a nod, though, during this Q&A session.
Yeah, Mish alluded to it earlier. Inflation hasn't really gone straight down the way some people expected, or at least it's stopped going down to the same degree. The economy's been holding up very well, the labor market. We just had a very strong GDP report, and it's going to be very difficult for them to acquiesce to the equity market's weakness in the face of those better economic data and stronger inflation numbers.
Michelle, a lot of focus next week on something we normally don't focus on, that's supply, right? Because, part of the yield story is just a lack of buyers. The Fed's backed out. Foreign buyers are gone. These auctions have been terrible. And this is a government that has an insatiable spending appetite. So we're holding on to find out just how much more they think they can raise next week.
Well, you're absolutely right. This is an interesting situation because usually the Fed is the biggest buyer, or the government, of the bonds. And right now it's just the opposite that's happening, and we don't have really any good foreign interest in buying our bonds either. It feels like a potential house of cards, and that is scary. But as you say, well, in the past, it's been a lot of money printing to try to help save things, and we see that sort of in the background. So I think at this point, we're having a stagflation environment set up, which is the worst economic time for monetary policy.
Right.
And that's what's happening.
Before I go, buying anything, or you just kind of...
Well, we mentioned commodities earlier. Without getting specific, because I can't, we still like the energy space. Obviously, oil is having a bit of trouble here, but a lot of these names are cash flow machines at this point, and we still like a lot of names in the space. And there's a lot of stuff on the consumer side of things, as long as the as long as you look at some, I can't say, but there are some things you can point to on the consumer side of things that are doing fine.
I don't want your phone to ring in the middle of this. Like, it's legal. They need to talk to you. All right, two of the best. Thank you both very much. Have a great weekend.